Why small-cap semiconductor stocks are about to have their biggest moment in years. Every major AI company right now is in a race to build bigger. More data centers, more chips, more power, more cloud infrastructure, billions of dollars flowing into making AI larger and more expensive by the day. And then a quiet breakthrough happened that points in the exact opposite direction. Smaller, cheaper, local. On your phone. On your laptop. No data center required. This video covers why analysts are now flagging small-cap semiconductor stocks as one of the most interesting areas of the market to watch right now. Stay until the end, because the investment angle on the story is not where most people are looking. And that is precisely why it is worth your attention. Start with the basics, because you cannot make a good investment decision about something you do not understand. Right now, almost every AI model you interact with runs on full precision floating point numbers. Every single parameter inside a model like GPT-4 or Claude is stored as a 16-bit value. Think of each parameter as a dial that can be set to millions of different positions. The more precise the dial, the more accurate the model. But also the heavier, the more power hungry, and the more expensive to run. The infrastructure that supports that kind of computation is what has driven the AI hardware boom. For the past 3 years, data centers, high-end GPS, massive power consumption, enormous capital expenditure from the hyperscalers, 1-bit computing flips that entire assumption. In 1-bit LLMs, every single parameter is ternary, meaning it can only take one of three values, -1, 0, or 1. That encodes approximately 1.58 bits of information per parameter rather than 16 bits. Instead of a dial that can sit at millions of positions, you have a switch that can only be off, neutral, or on. That sounds like a massive downgrade. For years, it was assumed to be one. The conventional wisdom in AI research was that you cannot compress a model that aggressively without destroying what makes it useful. The trade-off was not worth making. The conventional wisdom was wrong. Bitnappy 1.58, introduced by researchers from Microsoft Research, matches full precision models of similar size in both accuracy and real-world task performance, while using 3.55 times less GPU memory and running 2.71 times faster. Same performance, the fraction of the memory, significantly faster, and the energy story is even more dramatic than the speed numbers suggest. Now, here's where the investing story begins. Because every major technology shift creates winners and losers in the market, and 1-bit computing is pointing very clearly at a category of hardware that does not currently get much attention from retail investors. The current AI hardware boom has been almost entirely about GPS. NVIDIA has been the defining name. TSMC has been the foundry everyone watches. High-bandwidth memory companies have ridden the wave alongside them. All of that infrastructure is built around the assumption that AI requires massive floating point computation at scale in centralized facilities. That assumption has driven one of the most concentrated investment themes in modern market history. The Magnificent Seven. The AI infrastructure trade. The data center build-out. You already know the story. 1-bit computing does not need that hardware. It runs on CPS. It is optimized for what are called neural processing units, or NPS, the specialized chips now being built into laptops, smartphones, and edge devices specifically to handle local AI workloads without requiring a cloud connection. NPU support for BitNet is listed as coming next in Microsoft's development roadmap, which would bring these models to the neural engines in modern phones and laptops. That roadmap item is a signal. When Microsoft puts NPU support on a development roadmap for a technology this efficient, the hardware ecosystem starts planning around it. And the companies building those NPS are not NVIDIA. They are smaller, less followed, and in many cases trading at valuations that do not yet reflect where the technology is heading. Prismal, a startup founded by Caltech researchers, emerged from stealth in April 2026 with a $16.5 million seed round and an open-source release of a 1-bit LLM family designed specifically for consumer and edge devices, enabling AI applications in smartphones, wearables, and robotics without relying on cloud infrastructure. Vinod Khosla of Khosla Ventures participated in that seed round. Khosla is not someone who writes small checks into incremental ideas. His framing of the investment is worth repeating directly. He said AI's future will not be defined by who can build the largest data centers. It will be defined by who can deliver the most intelligence per unit of energy and cost. When a Tier 1 venture investor reframes the entire AI thesis around efficiency rather than scale, the market eventually follows. It may not follow immediately. Technology cycles rarely move as fast as the technology itself, but the direction of travel is being signaled clearly by people with a long track record of getting these calls right. The small-cap semiconductor companies worth watching are the ones building the processing infrastructure for local AI, ARM-based chip designers, whose architectures are optimized for low-power inference. Fabless semiconductor companies building dedicated NPU silicon for consumer devices. Edge computing chip makers supplying the automotive, robotics, and wearables markets. Firms working on the specialized memory architectures that 1-bit and low-bit models are optimized to use. These companies are not household names. They do not have NVIDIA's brand recognition or its analyst coverage, but they are positioned directly in the path of a major technology transition. Think about what local AI actually means for the semiconductor supply chain. Right now, if you run an AI query, that query travels from your device to a data center, gets processed on expensive GPU clusters, and the result comes back to you. The revenue in that chain flows to NVIDIA, to the cloud hyperscalers, to the high-bandwidth memory suppliers. The device in your hand is just a terminal. Local AI changes that chain entirely. The inference happens on your device. The chip doing the work is in your phone or your laptop. The company that made that chip captures the value that currently flows to the data center. That is a massive redistribution of where AI hardware revenue lands. And the companies building the chips optimized for that world are mostly in the small cap and mid cap space right now because the market is not yet priced in the transition. There is a broader market dynamic that supports this thesis. The hardware and software sectors of the tech industry diverge significantly starting in mid-2025, with hardware outperforming software by 171% to 72% by February 2026. The market has already started rotating toward AI infrastructure plays rather than pure software names. The next rotation within that hardware theme may be from the large-cap GPU-centric names into the smaller, more specialized firms building for the on-device era. Now the risks. Because any honest investment discussion requires them. Prism's claim that a fully 1-bit model can match the capabilities of higher precision systems remains unproven outside the company's own benchmark results. The technology is genuine and the progress is real. But 1-bit models today perform well on certain task categories and less well on others. The gap between a research demonstration and a commercially deployed product, running at scale across hundreds of millions of devices, is significant. Adoption timelines and semiconductor hardware are measured in years, not months. New chip architectures require design wins, manufacturing ramp-up, software ecosystem development, and device integration cycles that take time even when the underlying technology is ready. Small-cap semiconductor stocks also carry volatility that large-cap names do not. These positions can move dramatically on a single earnings report, a design win announcement, or a change in industry supply chain conditions. They require more active monitoring and a higher tolerance for short-term price swings than a position in an index fund or a large-cap tech holding. But here's the core thesis in plain language. The current AI boom is powered by an assumption that bigger is always better, and that centralized cloud infrastructure is the only viable way to deliver it. That assumption is being challenged by working technology that runs powerful models on everyday hardware at a fraction of the cost and energy. If that technology reaches mainstream device adoption, and the early evidence suggests it is moving in that direction, faster than the market currently expects, the companies building the chips optimized for that world are going to be positioned correctly at exactly the right moment. The data centers are not going away. The GPU build-out will continue. But the next wave of AI hardware spending may be flowing to the chip inside your pocket, rather than the server rack in Virginia. The small-cap semiconductor space is where that story is just beginning to develop. And right now, most of the market is still looking somewhere else entirely. If you want to stay ahead of the technology trends that move markets before the mainstream catches up, subscribe. This channel breaks down the investing opportunities worth understanding before everyone else does. Share this with someone who thinks AI investing starts and ends with NVIDIA.